Hello everyone. In this video we're going to continue our discussion about the accounting cycle, and we're going to be going over the closing entries. So in accounting there are two types of accounts. There's something called the permanent accounts, and there's also temporary accounts. Permanent accounts, sometimes we refer to it as real accounts, and these are the accounts that are related to the accounting equation, where we have assets, liabilities, and equity. Temporary accounts, these are temporary accounts that we want to close at the end of the accounting cycle, and we want to start fresh in the new accounting cycle. So these accounts are revenues, expenses, and dividends. Sometimes we call them nominal accounts. So we like to reset them or bring them back to zero, as if we are pressing a reset button to bring everything back to their initial value, which is zero. The permanent accounts, we want to move them with their ending balance from the previous year to the new year. So one more time, the balances of the accounts reported on the balance sheet are carried forward from year to year. These are the assets, liabilities, and accounts, and owner's equity or stockholders' equity. Because they are relatively permanent, these accounts are called permanent accounts or real accounts. The balance of the accounts reported on the income statement are not carried forward from one year to another. The balance of the dividends account, which is reported on the statement of stockholders' equity, is also not carried forward from one year to another. Because these accounts report amounts for only one period, they are called temporary or nominal accounts. Temporary accounts are not carried forward because they are only related to one period. So at the beginning of the next period, temporary accounts should have zero balances. Again, as I told you, it's as if we press a reset button to bring back things to zero balance. To achieve this, temporary account balances are transferred to permanent accounts at the end of the accounting period. So typically, they are transferred to the permanent accounts through the retained earnings account. The journal entries that transfer these balances are called closing entries. And we're going to see these closing entries, and we call this process the closing process, and sometimes we refer to it as closing the books. So if you ever heard of an accountant working in a private industry or private company, usually at the end of the year they're busy closing the books. So the closing process is very simple. It only involves two steps. The first step is that revenues and expense accounts balances are transferred to the retained earnings. The balance of the dividend accounts is transferred to the retained earnings account. So revenues, expenses, and dividends are the only accounts that we need to close. Revenues and expenses are usually closed together in one journal entry, and the dividends is also closed in a separate journal entry. So two closing journal entries are required. The first one, we debit each revenue account for its balance. And remember, revenues, they usually have a credit balance. So we want to close them, we get their balances and record them on the debit side. So that way we're closing it, because now the debit and credit would match, and that would make it a zero. Credit, we also need to credit each expense account with the same concept. Expenses usually have a debit balance. We want to close it, so we credit their balances. And then we credit net income if the difference is if the expenses are more than the revenue. I mean, if the revenues are more than the expenses. So we have a net income and we credit that into retained earnings. If expenses are more than the revenues, then we have a net loss, and in this case we debit retained earnings. The second journal entry involves dividends, and we debit the retained earnings account for the balance of the dividends accounts and credit dividends account for its balance. And remember, dividends usually have a debit balance, so when we're closing it, we credit it and we debit the retained earnings instead. So closing entries are recorded in the journal and are dated as of the last day of the accounting period. So let's see how this works. Again, one more time, just to get the idea. So the first stage here, we're trying to close the revenues and expenses. So we debit each revenue account for its balance. You see here, revenues, they have a credit balance. We debit the revenue account with the same balance. So this way it would have a zero balance. Then we credit each expense account for its balance. Expenses usually have a debit balance. We're going to record the same value on the credit side, and that would make it zero, because the debit and the credit now are equal. If the revenues and expenses, if we have more revenues than expenses, then we end up having net income. But if our expenses are more than the revenues, we end up having a net loss. The next thing is we credit net income or debit net loss to the retained earnings account. So you see here, if we have net income, we record the difference in the difference between revenues and expenses in the retained earnings credit side. If we have a net loss, we record the difference between the expense and the revenue on the debit side of the retained earnings. The second journal entry or closing entry is related to dividends. We debit the retained earnings account for the balance of the dividend account, and you can see here for dividends, it usually have a debit balance. We close it on the credit and we debit retained earnings with the value. So we expect to credit the dividends account for its balance. Now what's the balance for the dividends, the new balance? It's zero because we have credited the dividends account with the same value we have for its debit balance. So let's see an illustration for our company, which is NetSolutions. See here our revenues. They are on the credit side. We close them on the debit side and we take their total, and that's our total revenue here recorded just for our record. So and the same thing for expenses. They have all debit balances, and then we credit all the expense accounts: wage expense, supplies, rent, utilities, insurance, depreciation, and miscellaneous. So we credit them to close them, and we get their total, and that's the total of the expenses. As you can see, we have more revenues than expenses, so we end up having net income. This net income is what we're going to plug in the retained earnings on the credit side. If it was net loss, we put the value here on the debit side. Then for dividends, we had 4,000. We credited for 4,000 here to close it, and we record 4,000 on the debit side. So it's a very simple process. How we do that in the journal, that's what we're going to see here. On December 31st, we record the closing entries by debiting the revenues, crediting the expenses, and then plugging in the value of the difference in the retained earnings account. And then the second journal entry, again the same date, December 31st, we credit dividends and we debit retained earnings. And that's the journal entry to close the dividends. Once we have this journal entry recorded in the journal, the next step is to post it to the ledger. And by posting this to the ledger, we expect that all the revenues, expenses, and dividends account are going to end up having a zero balance. But we're going to still have some balances for all the real accounts, which are assets, liabilities, and equity. So you can see here under assets, we have cash, still has its balance. Accounts receivable still has its balance. Supplies, prepaid insurance, they have their balances. Land, office equipment, the depreciation or accumulated depreciation to be more specific, accounts payable, wages payable, unearned rent, common stock, and retained earnings. All of these, they have balances. The only account that was updated because of the closing entries from the permanent accounts is the retained earnings account. And you can see here the new balance is 3105. Now we have the temporary accounts where we have the dividends. Now its balance is zero, it's closed. Fees earned, which is a revenue, it's closed. Rent revenue, it's closed. That's a zero balance. Same thing for all the expenses. Wage expense, supplies expense, rent, utilities, insurance, depreciation, and miscellaneous, they all have zero balances. So once we post it to the ledger, the last stage is to prepare the post-closing trial balance. And remember, this is the third time we're preparing the trial balance. The first time was something called the unadjusted trial balance. And then we prepared the adjusting entries, and we prepared then the adjusted trial balance, which was the second type of trial balance. And then we had the closing entries, and now we need to prepare the post-closing trial balance. The post-closing trial balance is much shorter than the others because it does not have any of the revenues, expense, or dividends accounts. As you can see, it only has assets, has liabilities, and it has the equity accounts. But other than that, no revenues, no expenses, no dividends. And of course, it's still balanced. The debit side matches the credit side. So to summarize, the accounting cycle goes through 10 steps. Okay, so these steps, we call them the accounting cycle. And they start with analyzing and journalizing all the way to preparing the post-closing trial balance. So just to refresh your memory, the first step, we analyze and record the transactions in the journal. The second step, we post the transactions to the ledger. The third step, we prepare the unadjusted trial balance, which is the first form of trial balance. Then we make the adjustments. and these are assembled and analyzed. Then there's an optional step, which is to prepare a spreadsheet, end of period spreadsheet. And the appendix of this chapter has some discussion. I'm not going to stress too much on this. You can read it if you're interested. And then we have the next or the following step would be to record the adjusting entries and journalize them and post them to the ledger. Then we prepare the adjusted trial balance. And using the adjusted trial balance, we prepare the financial statements, starting with the income statement, statement of stockholders' equity, and then the balance sheet. And then we have another statement, which is the statement of cash flows, which does not rely on the adjusted trial balance. Then in step number 9, we close the entries. We have the closing entries and where we journalize them and post them to the ledger. And then finally, we prepare the post-closing trial balance. So just to give you a visual explanation of the accounting cycle one more time. Remember, the accounting cycle is start with analyzing the transactions, and this is always based on the accounting equation. So we have to always keep the accounting equation in mind, where we have assets equal liabilities and plus equity. So the first step, transactions are analyzed and recorded in the journal. Then they are posted to the ledger based on the rules of debit and credit. So remember, assets, they like the debit side, so they increase on the debit side and they decrease on the credit side. Liabilities and stockholders' equity, they have an opposite nature. Their normal balance is credit, so they increase on the credit side and they decrease on the debit side. Also, revenues and expenses, they have opposite nature to each other. Revenues, they like the credit side, they're recorded on the credit side because they follow retained earnings and the stockholders' equity. Expenses, on the other side, are increased on the debit side. Dividends, again, because they have opposite nature to retained earnings, they are increased on the debit side. And then we prepare the unadjusted trial balance once we have the ledger ready. The next step is to make the adjustments, and these are assembled and analyzed, and then we can have this kind of optional end of period spreadsheet, which is available in the appendix. The other way to do this, or easier way, is to go directly to prepare the adjusting entries and journalize them and post them to the ledger, and then we prepare the adjusted trial balance. The adjusted trial balance is important because this is the one that's used in the preparation of the financial statements. So the financial statements are prepared. Okay, and you can see here we have the income statement, statement of stockholders' equity, and the balance sheet, and that's the order that we have to follow to prepare these financial statements. Then we have the closing entries. These are journalized and posted to the ledger, and then the last step is to prepare the post-closing trial balance. So let me stop here. In the next video, we are going to just go over an example for the company where we're going to go through the entire accounting cycle very quickly and then just do some quick analysis.